Welcome to Iron Financial, the only place where we forge stronger portfolios by cutting through all the market weakness. You know, in today's environment, you absolutely cannot just take a bank's word for it. No way. You have to pressure test the financials, you got to inspect the foundation, and you have to look for those tiny cracks before they turn into giant chasms. So today, M&T Bank is on the inspection block. We are putting their latest numbers through a full-blown structural analysis to figure out if this is a fortress for your capital or just a facade that's waiting to crumble. Okay, let's get into it. So we're going to start with the official blueprint, straight from the company itself. This is the narrative, right from their Chief Financial Officer, Daryl Bible. You hear the keywords, right? Strong financial performance, fundamentals remain strong, positioned for growth. I mean, this is the story they want every single investor to hear, to internalize, and to believe.
And hey, it's a great story. I mean, who doesn't love strong fundamentals? But let's be real. A blueprint is just a piece of paper. The real question, the only question, is whether the actual structure they built even matches the plan. Does this super optimistic view hold up when you start applying some real, actual pressure? Or is it just a nice, fresh coat of paint slapped over some really serious stress fractures?
Exactly. And that's precisely what our framework today is designed to find out. We are going to run a complete financial stress test. First up, we'll scrutinize that official blueprint. Then we're going to assess the full year's structural integrity. After that, we put the most recent quarter under the microscope with a quarterly stress test. Then, and this is my favorite part, we get to the heart of it, inspecting the core engine, which is the balance sheet. We'll then look at their 2026 outlook, and finally, we will deliver the iron verdict.
And this, right here, is the central tension for our entire analysis today. Is the CFO's confidence statement a true, honest reflection of the company's health? Or does the financial reality, the hard data, reveal underlying weaknesses that this corporate narrative just conveniently papers over? This is the real battleground, the story they tell you versus the numbers they actually report. Let's find out which one's stronger.
All right, time to start the heavy lifting. Section 2, full year structural integrity. Look, any real financial analysis has to start at the foundation. We're digging into the full year 2025 results to see if this bank is built on solid rock or on shifting sand. You have to look at the long-term picture. It's the only way to know about the core strength of the entire operation. Okay, so this slide lays out the full year results in two different ways. I want you to focus on the right-hand table first, the non-GAAP results. This is the version management wants you to see, the one they highlight. And you have to admit, it looks great. Your eyes go right to that net operating income line, $2.88 billion. That's a clean, powerful number that's supposed to show the core profitability of the bank's day-to-day business. It's the number they build their entire story around. Whoa, hold on a second. Before you get completely mesmerized by that shiny non-GAAP number, just pull your eyes over to the left. The GAAP results. GAAP, generally accepted accounting principles. It's the official audited rulebook. And more importantly, look at that table below it on the slide. Notable items. Yeah, this is all the stuff they've excluded to get to that pretty operating income number. So the question for us, the critical question, is what exactly are they asking us to ignore here, and why shouldn't these items be considered part of operations? It's a really critical distinction.
Yeah, let's drill down on these adjustments because this is where the whole story can start to change. So they've excluded a $37 million FDIC special assessment. I mean, that's cash right out the door. They also excluded a $28 million earnout payment from a business they sold. Again, that's real money. And they even took out a $30 million charitable contribution. These are real, tangible costs. So analysts, make the case. Why on earth should an investor just pretend these costs didn't happen?
Because they are distractions, they're noise. They are not part of the core, repeatable, day-in, day-out business of banking. That FDIC assessment, it was a one-time industry-wide levy to basically refill the insurance fund after all those bank failures in 2023. It's got nothing to do with M&T's unique performance. The earnout is just a trailing payment from a strategic move they made years ago. You have to separate the signal, the core business, from the noise of these one-off events. And these items are pure noise. Focusing on them is like trying to inspect a building's foundation in the middle of an earthquake. It's just pointless.
And this number right here brilliantly illustrates why we make that separation. When you filter out all that one-time noise and you focus on the core operational signal, what do you get? You get this. A powerful, undeniable 16% year-over-year growth in diluted net operating earnings per share. That's the entire point. 16%. That isn't just growth. That's a massive pillar of performance that shows you the underlying profit engine is actually getting stronger, not weaker. This is the number that tells you if the core business is truly firing on all cylinders. And you know what? It is. A strong pillar for the full year. Okay, I'll grant you that. But the market is a forward-looking beast, isn't it? It doesn't care nearly as much about the last 12 months as it does about the last 3.
and more importantly, what that implies for the next 3. So while that annual picture looks pretty sturdy, the most recent quarter is always where the first signs of stress start to appear. So let's move on to our quarterly stress test and really put Q4 under the microscope. Okay, let's do it. Let's look at Q4. Now, if you just glance at the bullet points here on this slide, the story of strength seems to continue. Diluted net operating EPS, that's the first bullet. It grew an impressive 20% year over year. That's even stronger than the full year number. And check out the last bullet. Tangible book value per share is up 7% year over year. For those who might not know, that is a key measure of a bank's net worth. It strips out all the fuzzy, intangible assets and tells you what the core physical value of the company is per share. Seeing that grow is a sign of real, fundamental value creation. So by these metrics, the fourth quarter looks like it's just a continuation of that full-year momentum. It's like another solid block in the foundation.
But you see, this is exactly why we look at things from multiple angles. Let's flip to this next slide, because it shows a completely different narrative. The year-over-year numbers you just rattled off are fine. They're good headlines. But look what happened when you compare it to the last quarter. This chart shows the quarter-over-quarter change. And this is where we find a crack. That diluted net operating EPS, the same metric you just championed for its 20% yearly growth, was actually down 3% from Q3. Net operating income fell 4%. This is a sequential decline. So the key question for any investor has to be, is this just a minor dip, a temporary blip, or is this the beginning of a seriously negative trend? Because from here, it really looks like the momentum is starting to shift downward.
Well, to answer that, you have to go deeper than just the income statement. You have to pop the hood and inspect the core engine itself, and that's the balance sheet. This is where the bank holds all the assets that actually generate the profit. The quality, the composition, and the durability of this engine, that's what will determine if that quarterly dip was just a little sputter or a sign of some serious, deep-seated trouble.
Okay, so let's break down their investment portfolio. We're talking about almost $54 billion in securities and cash. This chart breaks it all down for us. The biggest piece of the pie, that 43% purple slice, is in what we call available for sale, or AFS, securities. These get marked to market all the time. The next chunk, that 32% light blue slice, is basically just cash sitting in interest-bearing accounts. Very, very safe. But the piece I really want us to zero in on is that 23% green slice, held to maturity, or HTM securities. Understanding what this is absolutely key to understanding the bank's true risk profile.
And this right here is exactly where I see a massive crack in the armor. Let's just look at the unrealized gains and losses on these securities, all laid out for you in this table. The AFS portfolio, fine, it's got a respectable $208 million gain, no problem. But then, look at the HTM portfolio. It is sitting on a staggering bright red $717 million pre-tax unrealized loss. That is almost $750 million in paper losses. You just can't build a fortress on top of a ticking time bomb like that. This is a huge vulnerability, a hidden weakness that doesn't show up anywhere in that pretty operating income number we talked about earlier.
It's only a vulnerability if you don't understand the accounting. Look, it's absolutely crucial to know what HTM actually means. These are bonds that the bank has the stated intent and the ability to hold all the way until they mature. Think of it like a loan. As long as you hold it to the very end, you get your principal back, period. Because of that, the daily up and down fluctuations in their market price, those unrealized losses you're pointing to, they do not flow through to impact their regulatory capital. It's a paper loss that only becomes real if they are forced to sell, and they have no intention of selling. So it doesn't affect the structural integrity of their capital base at all.
And this number right here, this is the ultimate defense, the final backstop. It's the Common Equity Tier 1 capital ratio. You'll hear it called CET1. I want you to think of this as the ultimate measure of a bank's ability to absorb a shock. M&T's is estimated at 10.84%. This is the high tensile steel reinforcing the entire bank. It is way, way above the regulatory minimums, which provides a massive cushion. That $717 million paper loss is a concern on paper, sure, but this 10.84% ratio is the real-world armor that protects the bank from any actual harm. It means they can withstand enormous losses before their stability is ever truly at risk.
And just look at what a management team with this much excess capital does with it. They're not sitting on it, scared of shadows in the corner. No, they are returning it to shareholders with conviction. In 2025 alone, they bought back 9% of the entire company. They spent over $500 million just on buybacks in Q4. And on top of all that, they jacked up the quarterly dividend by 11%. This is not the behavior of a company that's worried about its foundation. This is a massive vote of confidence from the people who know the business best, basically telling you they believe the stock is undervalued and the fortress is absolutely secure.
That's a strong point. Management's actions do speak loudly, but they also speak through their guidance. Confidence in the past year is one thing, but what does the blueprint for the future actually look like? Let's transition over to their 2026 outlook. Does their own forecast show them continuing to build this impenetrable fortress? Or are they maybe subtly admitting that there are challenges on the horizon and construction is about to slow way down? All right, this is it. This is the company's official 2026 outlook. This is the financial map that they have handed over to Wall Street for the year ahead. We are going to break down all the key assumptions here, everything from income and expenses all the way down to their capital targets. This is what tells us where they plan to steer the ship.
So when you break down this guidance, you see a really clear blueprint for a steady, shareholder-friendly operation. First, they're guiding net interest income to a range of $7.2 to $7.35 billion. That signals a stable and very predictable core profit engine. Second, they're showing really good expense discipline. Third, and this is super important, look at their target CET1 ratio, 10.25 to 10.5%. Now remember, they're currently at 10.84%. By setting a lower target, they are explicitly telling the market, we have excess capital and we are going to deploy it through more share repurchases.
Okay, I see all of that, but I also see number 3, cautious growth. They're guiding total loans to a range of $140 to $142 billion. That's very modest, very controlled expansion. You could frame that as discipline, sure, or you could frame it as a sign that management sees a slowing economy and is deliberately pulling back on taking risks. It's not exactly a roaring growth story they're painting for the year ahead, is it?
That's a very fair point, which brings us to our final section. We've examined the official story, we've stress-tested the annual and the quarterly results, we've inspected the core balance sheet engine, and we've looked at the blueprints for 2026. So now, after analyzing every single major component, it is time for Iron Financial to deliver its final verdict. So it really all comes down to two competing narratives, which we've laid out right here on this slide. The bull case, what we're calling the fortress, is built on undeniable facts. 16% year-over-year growth in operating EPS, a rock-solid CET1 capital ratio of 10.84% that acts like a massive shock absorber, an aggressive and confident capital return program, and a really stable outlook for the year ahead. But the bear case, the cracks, is just as clear if you're willing to look for them. The momentum has clearly shifted, with negative quarter-over-quarter trends in both income and EPS. There's a huge $717 million unrealized loss just lurking in that bond portfolio. That's a risk you just can't ignore. The entire positive earnings story relies on these non-GAAP adjustments that conveniently leave out real costs. And the guidance for loan growth is, well, it's uninspiring at best, and it really suggests they see some headwinds coming.
So which one is it? Is it an opportunity or is it a trap? Well, at Iron Financial, after running the full stress test, our verdict is that M&T Bank represents a financial fortress. The cracks that we've identified are, in our view, surface level. That quarter-over-quarter dip appears to be just noise within a much stronger, long-term uptrend. The unrealized losses in that HTM portfolio, they're contained by an exceptionally strong capital base, and frankly, it's an industry-wide issue, not an M&T-specific problem. The combination of strong core profitability and an aggressive commitment to returning capital to shareholders makes this a really compelling structure. The foundation is solid. The foundation is solid today, I'll give you that. But I'm going to leave you with this one final, provocative question to think about for your own portfolio. Management has explicitly told you they plan to operate with a lower capital cushion in 2026, all to fund more share buybacks. So the question is, how will they balance the immediate gratification of those shareholder returns against the long-term risk that is still hidden deep in that bond portfolio? That's the tightrope they, and by extension their investors, will be walking all year long. Think about it.
I am not a financial advisor. This is for educational and entertainment purposes. Do your own research.